Lesson: Stakeholder risks in blockchain ecosystems. Blockchain ecosystems, characterized by their decentralized nature, present unique challenges and opportunities in managing stakeholder risks. Stakeholders in these ecosystems range from developers and miners to end users and regulators, each with distinct interests and risk profiles. To effectively manage these risks, professionals must employ actionable insights, practical tools, and robust frameworks that can be directly implemented in real-world situations. This lesson delves into the intricacies of stakeholder risks in blockchain ecosystems, offering a comprehensive exploration of strategies and tools to manage these risks effectively. In blockchain ecosystems, stakeholder risks can be categorized into several dimensions, including technological, regulatory, financial, and reputational risks. Technological risks are inherent due to the complex and often experimental nature of blockchain technologies. For instance, smart contracts, which are self-executing contracts with the terms of the agreement directly written into code, can contain vulnerabilities that malicious actors could exploit. The infamous DAO hack in 2016, which resulted in the loss of $60 million worth of Ether, highlights the financial and reputational risks associated with technological vulnerabilities. To mitigate such risks, stakeholders can utilize formal verification tools, which mathematically prove the correctness of smart contracts. Tools like OpenZeppelin's Solidity library provide frameworks for secure smart contract development, offering reusable and secure components that reduce the potential for errors. Regulatory risks are another critical concern for stakeholders in blockchain ecosystems. The decentralized and borderless nature of blockchain often places it in a gray area concerning regulatory compliance. Regulators worldwide grapple with balancing innovation and consumer protection, leading to inconsistent regulatory environments. For instance, the Securities and Exchange Commission in the United States has taken action against several initial coin offerings for violating securities laws, illustrating the financial and operational risks for stakeholders engaging in such activities. To address regulatory risks, stakeholders can adopt a proactive approach by implementing compliance frameworks such as the Blockchain Technology Regulatory Framework. This framework assists in identifying applicable regulations and establishing compliance protocols tailored to the specific jurisdiction of operation. Financial risks in blockchain ecosystems are multifaceted, encompassing market volatility, liquidity risks, and investment risks. Cryptocurrencies, a significant component of blockchain ecosystems, are notoriously volatile. The price of Bitcoin, for example, has seen dramatic swings that pose substantial risks to investors and businesses accepting cryptocurrencies as payment. To manage such risks, stakeholders can employ financial instruments like derivatives and options to hedge against price volatility. Additionally, using stablecoins, cryptocurrencies pegged to stable assets like fiat currency, can mitigate exposure to market fluctuations. Reputational risks are particularly crucial in blockchain ecosystems, where trust and credibility are paramount. A blockchain project's success often hinges on its perceived integrity and security. The Mt. Gox exchange collapse in 2014, resulting in the loss of 850,000 bitcoins, severely damaged the reputation of cryptocurrency exchanges and highlighted the importance of robust security measures. Stakeholders can mitigate reputational risks by implementing best practices in cybersecurity, such as regular security audits, penetration testing, and employing multi-signature wallets for fund management. Furthermore, transparent communication with the community and stakeholders during crises can help maintain trust and credibility. Beyond these risk categories, stakeholder management in blockchain ecosystems requires a nuanced understanding of the governance structures inherent in different blockchain models. Governance in blockchain can be broadly categorized into on-chain and off-chain governance. On-chain governance involves stakeholders voting on protocol changes directly within the blockchain, exemplified by projects like Tezos and Decred. While on-chain governance offers transparency and direct stakeholder participation, it can also lead to centralization risks if voting power is concentrated among a few large stakeholders. In contrast, Off-chain governance relies on informal decision-making processes and discussions among stakeholders, as seen in Bitcoin and Ethereum. While this model allows for flexibility and adaptability, it can also lead to decision-making gridlock and conflicts among stakeholders with differing interests. To navigate these governance challenges, stakeholders can employ decision-making frameworks such as the RACI matrix, which clarifies roles and responsibilities within the governance process. By defining who is responsible, accountable, consulted, and informed for each decision, stakeholders can streamline governance processes and reduce conflicts. Furthermore, the alignment of incentives among stakeholders is crucial to mitigating risks in blockchain ecosystems. Misaligned incentives can lead to behaviors that undermine the system's stability and security. For instance, miners in proof-of-work blockchains are incentivized to prioritize profit over network security, potentially leading to issues like selfish mining attacks, where miners secretly mine a longer blockchain fork to gain an unfair advantage. Stakeholders can address incentive misalignment by designing consensus mechanisms that align the interests of all participants. Proof-of-stake and delegated proof-of-stake are examples of consensus mechanisms that align incentives by requiring validators to hold and lock up tokens, thus encouraging them to act in the network's best interest. Risk management frameworks, such as the Enterprise Risk Management Framework, can provide a structured approach to identifying, assessing, and mitigating stakeholder risks in blockchain ecosystems. The ERM framework encompasses risk identification, risk assessment, risk response, and risk monitoring, offering a holistic approach to managing risks across an organization. By integrating ERM with blockchain-specific considerations, stakeholders can create a comprehensive risk management strategy that addresses the unique challenges of decentralized systems. Additionally, scenario analysis and stress testing can be valuable tools for stakeholders to anticipate and prepare for potential adverse events in blockchain ecosystems. Scenario analysis involves examining hypothetical situations to assess their potential impact on the system, while stress testing evaluates the system's resilience under extreme conditions. By simulating various risk scenarios, stakeholders can develop contingency plans and enhance the robustness of their risk management strategies. In conclusion, managing stakeholder risks in blockchain ecosystems requires a multifaceted approach that encompasses technological, regulatory, financial, and reputational considerations. By employing practical tools and frameworks such as formal verification, compliance frameworks, financial hedging instruments, cybersecurity best practices, and governance decision-making frameworks, stakeholders can effectively address the diverse risks they face. Furthermore, aligning incentives and integrating comprehensive risk management frameworks like ERM can enhance a blockchain ecosystem's resilience and stability. As blockchain technology continues to evolve, stakeholders must remain vigilant and adaptable, continuously refining their risk management strategies to navigate this dynamic landscape successfully.